Boom! What's up, Waves Capital? It's Royce Jacob, and welcome back to the channel. In this video, I want to talk to you about the January effect and why I believe this theory will be especially effective as we head into the new year of 2023. Okay, so we will spend the far majority of this video understanding the January effect, and to do so, I want to read through this great article written by Mr. James Chen of Investopedia titled January Effect, What It Is in the Stock Market, Possible Causes. Okay, and more importantly, is the January effect a tradable seasonal strategy? Okay, so as we read through this, I do want to talk to you guys briefly about my personal trading strategy as we enter the new year. I did just imply, just during that intro, that I am bullish on the markets going into the new year. This is primarily due to the oversold nature of the markets. After we read through this, I do want to quickly touch on Tesla. I know I just uploaded a video on Tesla prior to this one, so go check that out if you want, where we dive into the technicals. But really just talk about down 11% as I read through this on Tuesday, December 27th. Insane day for Tesla. Poor Elon. But talk about the oversold nature of the markets, talk to you guys about why we are more prone for the January effect to kick into effect as we enter the new year. And once again, really just emphasize the concept of tax loss harvesting, which, as we'll touch on in here, is kind of the simple concept of just selling your losers to offset any income that you generated in the prior year. Okay, and that's really what's happening, as we can see with poor Tesla right now. Okay, on top of that, to reinforce kind of my bullish thesis as well, I do want to touch on the fear and greed index. This is just the culmination of 7 different indicators within the markets that dictates general investor fear or greed, or again, anywhere, places it anywhere on the spectrum due to or with those indicators, with those 7 indicators once again. And again, we're in fearful zones. I want to talk to you guys about why I don't think it's quite necessary for us to be in a state of fear at this moment in time. Okay, but once again, let's get to reading this. Before we do, please give the video a like if you do want to gain value from it. Let me know if you're bullish on the markets going into the new year, if you think we will enter the new year with some fireworks, fingers crossed. And just let me know what you guys are thinking. What are you trading? Of course, if you do want to know what I'm trading on a daily basis, if you want my daily newsletter, just talking about why I'm trading, what I'm trading, when I'm trading it, that's the first link down below, but more on this at the end of the video. Okay, appreciate you guys watching. Let's get into reading. So what is the January effect? The January effect is a perceived seasonal increase in stock prices during the month of January. Analysts generally attribute this rally to an increase in buying, which follows the drop in price that typically happens in December when investors engaging in tax loss harvesting to offset realized capital gains prompt a sell-off. Okay. Another possible explanation is that investors use year-end cash bonuses to purchase investments the following month. While this market anomaly has been identified in the past, the January effect seems to have largely disappeared as its presence became widely known. Indeed, our own look back at the SPY ETF since its 1993 inception, so the S&P 500, again, pretty much benchmark equity index for the U.S. Equity market. Since its 1993 inception makes one wonder how the term ever came to be used. Of the 30 years since 1993, there have been 17 winning January months. So 57% hit rate, not crazy, but more likely than not. Okay, and 13 losing months, 43%, making the odds of a gain only slightly higher than the flip of a coin. Further, since the start of 2009, the 2009 market rally through January of 2022, January months showed 8 winners versus 6 losers. Again, a split of 57% to 43%. Given the strong rally from 2009, one might rightly expect a more pronounced number of January winners, but this is not the case. Traders should be aware of the tenuous nature of the January effect and instead focus on the market conditions at the time and what they suggest for the overall short-term direction of the S&P 500. And once again, that is why we will reference these two right here. Okay. So, key takeaways. The January effect is the perceived seasonal tendency for stocks to rise in that month. In the bigger picture, since 1938, 29 out of 30 years of gains seen in January to February resulted in an average yearly S&P advance of 20%. So, if we kick off the year strong, yeah, that's the beauty of kicking off the year on a strong foot. It's pretty likely that the rest of that year will be strong with, and this is with almost 100% hit rate. Okay, talking like 97, 98%. Very good likelihood. I'll take that trade 100% of the time. The January effect is theorized to occur when investors sell losers in December for tax loss harvesting, only to rebuy new positions in January. Yeah, bingo. That's the big one. There's, again, fears of a general recession. There is a lot of a lot of broken technicals. But the primary reason is, once again, tax loss harvesting, where investors are selling their losers, offset some of that income that you generated in 2022. Like other market anomalies and calendar effects, the January effect is considered by some to be evidence against the efficient market hypothesis. More to the point, over the past 30 years, January gains have occurred 17 times, 57%, while losing January months numbered 13 or 43. Once again, barely better than the flip of a coin. Understanding the January effect. The January effect is a hypothesis, and like all calendar-related effects, it would suggest that the market as a whole are inefficient, as efficient markets would naturally make this effect non-existent. The January effect seems to affect small caps more than mid caps or large caps. Perfect for waves cap, because of course that is typically what we are trading, because they are less liquid. Okay, since the beginning of the 20th century, the data suggests that these asset classes have outperformed the overall markets in January, especially toward the middle of the month. Investment banker Sidney Watchell first noticed this effect in 1942. The historical trend, however, has been less pronounced in recent years because the markets have seemed to have adjusted for it. Another reason analysts consider the January effect less important as of 2022 is that more people are using tax-sheltered retirement plans and therefore have no reason to sell at the end of the year for a tax loss. 401ks, Roth IRAs, etc. Taxes don't really matter. Tip: the efficient market hypothesis states that share prices reflect all the information that is available to the market. Based on the theory, since all market participants have access to the same information, outperforming the market through stock selection or market timing is not feasible. The efficient market hypothesis is an argument against seasonal phenomena like the January effect. And again, you guys, you can argue the efficiency of the markets. It's nice to believe the markets are hyper efficient. They're great at pricing things in. But, as we've seen over the past 6 months, 12 months, it's pretty evident that no one knows how to price anything in. So the more time I spend in the market, especially in this kind of fairly new environment of raising interest rates, the more evident it becomes that the markets aren't very efficient. That's the unfortunate reality or inefficient reality of the markets, okay? So, January effect explanations. Beyond tax loss harvesting, keep in mind, you guys, that's absolutely the number one cause for the January effect. At least in my mind, that seems very obvious. As well as investors putting cash bonuses into the market. It's another one. Another explanation for the January effect has to do with investor psychology. Some investors believe that January is the best month to begin an investment program, or perhaps follow through on a New Year's resolution to begin investing for the future. Others have posited that the mutual fund managers purchase stocks on top of performers at the end of the year and eliminate questionable losers for the sake of appearance in their year-end reports, an activity known as window dressing. This is unlikely, however, as the buying and selling would primarily affect large caps. Year-end sell-offs also attract buyers interested in the lower prices, knowing that the dips are not based on company fundamentals. On a large scale, this can drive prices higher in January. Studies and criticism, and this is kind of where we'll round it down, okay, you guys. An ex-director from the Vanguard Group, Burton Malkiel, an author of A Random Walk Down Wall Street, has criticized the January effect, stating that such seasonal anomalies don't provide investors with any reliable opportunities. He also suggests the January effect is so small that the transaction costs needed to exploit it essentially make it unprofitable. And has also been suggested that enough people know about the January effect that has become priced into the market, nullifying it altogether. So, again, you guys, the way things are looking, the January effect is absolutely not priced in just yet. Okay, so it comes back down once again to this efficient market hypothesis. And just to sum that up once again, because I just covered it, the markets aren't very efficient, at least in my belief. And that's kind of something that seems more and more apparent to me, as I spend more time in this game. Okay. Other researchers have found that the January effect still exists, but only for smaller cap stocks, owing to a lack of liquidity and interest from investors. What is the January effect in the stock market? The January effect is purported market anomaly whereby stock prices regularly tend to rise in the first month of the year. Actual evidence of the January effect is small, with many scholars arguing that it does not really exist. So once again, we don't need to read through that once more. Can you make money exploiting the January effect? Unlikely. Even if the January effect were real and the markets were to rise uncharacteristically each January, the fact that people may try to exploit this can undermine its fruition. And again, I wanted to read this because it's always good to understand both sides of the argument, but I don't agree with this. Okay, so I want to make that clear. I do think the January effect, especially given once again the market backdrop right now, fearful environment, Tesla falling off an absolute cliff, just a microcosm of what's going on in the greater markets. I think the January effect will absolutely come into play. So what is the January barometer? The January barometer is a folk theory of the stock market claiming that the returns experienced in January will predict the overall performance of the stock market for that year. Thus, a strong January would predict a strong bull market, and a down January would pretend a bear market. Actual evidence for this effect is scant. But once again, 29 out of 30, as we read above, January and February. If January and February are green, the average return for the S&P on an annualized basis is 20% for that year. So that, again, is nearly 100% hit rate. That is a trade. If we get a green January, February, I'm buying all the November calls, all the November, December calls that I possibly can with my money, okay? Because that's a trade. As a trader, again, weighing out the odds, understanding asymmetric risk profile where the upside potential outweighs the downside risk, that is a pretty damn ideal trade, okay? So let's close it out, you guys. The so-called January effect is a market theory holding that January frequently sees less regular gains for the month. The evidence for this effect is tenuous at best, with again 57 to 43 odds. Still, the January effect is a relatively popular rationale used by market commentators to explain any positive gains in the month of January. They may attribute any buying in January to the fresh buying after year-end tax loss selling, although this is becoming less significant. Traders should be cautious about blindly following the mythology of the January effect and instead focus on the current conditions leading into the end of the year. And once again, those current conditions on top of the 57-43 odds, which still favor a green January, do lead me to believe that the odds are heavily in favor of the January effect kicking into gear, kicking into high gear, that is as well. Tesla specifically, for full transparency, I do hold a pretty meaningful amount of late January Tesla calls. And I did buy even more of those today on this pullback, okay? So, again, if you guys do want to know how I'm trading on a day-to-day basis, if you guys want to know all the call options, my Tesla calls are only a small part of my call options portfolio. I actually have a lot of longer-term April, May call options in the mix as well. If you guys want to know what my entire personal portfolio consists of and how I traded on a day-to-day basis, along with my daily newsletter, which I send out every trading day during market hours, the trade alert and the price targets newsletters. That's going to be the first link in the description box down below. $15 a month, $40 for every 3 months. Try free for 7 days into the new year. And if you don't like it, just unsubscribe. It's that easy. But I trust you guys will be sticking around. Welcome to the winning team in advance if you do. And I look forward to seeing you guys on the inside. Once again, let me know in the comments down below what you think about the January effect. Do you think it's real? Do you think it's BS? And of course, let me know why. And let me know how you're trading going into the new year. Okay? So, I appreciate you guys watching. And until next time, always remember, take action, make waves. Peace.